Hi, everybody. My name is Catherine Gildy,
And I'm Jacob Schrupp.
and today we're going to be talking about the Walt Disney Company. So, you may be asking, who is the Walt Disney Company? Well, their mission statement is the mission of the Walt Disney Company is to entertain, inform, and inspire people around the globe through the power of unparalleled storytelling, reflecting the iconic brands, creative minds, and innovative technologies that makes us the world's premier entertainment company. The Walt Disney Company is a company that stands on the idea of being a diversified, worldwide entertainment company. Since its start, Disney has become a premier company focused on the idea of being the most renowned company that focuses on being family friendly. The company has four segments: direct to consumer and international, parks, experiences, and consumer products, media networks, studio entertainment. Now, each segment plays a role into the company. For example, the direct to consume and international focuses on globalizing and distributing content, consumer goods, and services worldwide, such as Shop Disney and Disney Plus. Parks, experiences, and consumer products focuses on their theme parks and resorts worldwide, such as Disneyland Resort and Tokyo Disneyland, and also looks into consumer products as well to see what appeals to their target audience as well. Media networks is also another example, which produces media to the general public using places like Disney Channel. And finally, studio entertainment produces movies with other studios like Pixar, Marvel, or Lucasfilm. So now we're going to talk about the background on the company. The Walt Disney Company started on the date of October 16th, 1923. The company was initially called Disney Brothers Cartoon Studio, as Roy and Walt Disney were working together at the time. What started with the short film Alice's Wonderland helped Walt to find his place in the industry because soon after he developed Mickey Mouse in 1928. This popularity led him to continue his ambition with Snow White and the Seven Dwarfs in 1937. Walt started to create different animated films, but he wanted to do more. Disneyland revolutionized the theme park industry as a whole. It used its creative perspective and put things like safety and cleanliness first, which drew in crowds. Not only that, but it also brought families together. But what was next for the company? The company decided before Walt passed in 1966 to create the Magic Kingdom in Epcot in Florida. Roy helped and took over the company to finish Walt's legacy. Walt wasn't able to see these finished products. By 1983, the company had taken advantage of merchandising, continued producing feature-length films, and had started creating different theme parks internationally, such as Tokyo Disneyland in 1983.
All right, so Disney also has a lot of direct-to-consumer and international entities that they go through in order to make some money for themselves. So Disney Plus is probably Disney's biggest thing right now. That is all of the new things that they've come out with and all of the old things that they have. So they have all of Disney's original movies and TV shows. And they also have all of the new Marvel movies, Star Wars movies, Pixar movies, and National Geographic movies and TV shows. Another thing that they have is Hotstar. And Hotstar is a streaming service that was in Malaysia, and Disney ended up buying them out and adding them to Disney Plus for their Malaysian content. So now this adds a lot more. As long as you have the Hotstar Disney Plus, you have a lot more Malaysian content and all of those kinds of things for other countries. Disney Plus and Hotstar have a combined 161.8 million users worldwide. And so they have a lot of money tied up in those. Another thing they have is ESPN Plus. Now this covers sports across the world, whether it's live sports or original content, say like 30 for 30 or anything like that. They also have all game replays. And so you will be able to watch all of your favorite sports with ESPN Plus, and you're not really going to have to worry about missing anything or having to find anything like that. ESPN Plus has 17.1 million users worldwide. And so there's a lot of people using this to either catch up on their live sports or watch sports live. Another thing that Disney owns is Hulu, and Hulu contains a library of TV shows and movies from a bunch of different networks like CBS, NBC, ABC, FX, and they also have Hulu Originals. And so they just have a lot more They have a lot more entities on there, and there's a lot of hours of TV that you were able to watch on those on demand instead of having to wait for the networks to replay them. Hulu has 43.8 million users. One more thing that they have is called Star Plus. So Star Plus is a Latin American streaming service that complements Disney Plus. So just like Hotstar, Disney Plus also has a Star Plus add-on that you can get in order to add more Latin American content. Another thing that Disney has that makes them a lot of their money is their parks, experiences, and consumer products. So the big three parks that I'm going to be talking about right now are Walt Disney World in Orlando, Florida, Disneyland in Southern California, and Shanghai Disney. So Walt Disney World in Orlando, Florida was opened in 1965, and it sees an average of 53,000 visitors per day. Now, with an average single day ticket being $134, that would be making them over $7 million a day. Now, Disney Plus, or Disneyland in Southern California in Anaheim was opened in 1955, and that sees an average of 44,000 visitors per day. The average single day ticket there is $157, so they will be making $6,908,000 every day if you just count ticket sales. Shanghai Disney is located in Shanghai, China, and was opened in 2016. They see an average of 20,000 visitors every day. And for them, a single day ticket is $62. So they will be making just over $1 million every day just in ticket sales. Now, these are all averages, and with COVID, everything had to be shut down. So all of these numbers are very skewed right now. They are not going to be able to recover as much or as quickly with all of these ticket sales being lost. But since they are opening back up, they're having a boom again with the amount of people that are coming, and everybody wants to go see Disney because they haven't been able to for so long. Moving on to the media networks of Disney, there are all kinds of Disney owned TV shows, radio channels, regular cable channels, and some of those being ABC, Radio Disney, ESPN, and just Disney Channel. They have Disney XD and a few other ones that they run on cable TV. They make all of their revenue on these through the fees that are charged by the cable companies and the other providers. So that's how they're going to be making their money and being paid by those guys. So Disney also has strong connections with ABC, A&E, FX, and National Geographic, which means that they have a say in what happens with them and how they are run. And so Disney is able to influence them a little bit. Now, these connections allow them to be affiliated with them, and they're also still their own entities, so they're able to be run by themselves, but Disney definitely still has a big say in how they're run and how everything goes. So for studio entertainment, Disney has been acquiring all kinds of companies all around in every different facet and every different theme that they have. Over the last few years, some of the big acquisitions have been of Lucasfilm, who created all of the Star Wars movies. That would be the first 6 Star Wars movies. So Disney acquired Lucasfilm for $4.05 billion in cash and $1.855 billion in stock. So that went directly to George Lucas, and because he was at the head of all of Lucasfilms. And so now Disney bought all of that from him. So Disney also acquired Marvel in 2009 for $4 billion. And then after that ended up acquiring Spider-Man in 2011. And they've already made 2 films with a third on the way on December 17th. So that's our little plug for everybody to go see Spider-Man No Way Home. All right, some of Disney's key competitors are going to be Comcast, Time Warner, 21st Century Fox, and those are going to be the 3 guys that are going to be competing with, and the CBS Corporation, And that is going to be who is going to be competing with Disney Channel and like their cable stuff. So that's going to be everything that's on TV right now. Netflix and Amazon Prime are definitely going to be direct competitors to Disney Plus and all of their streaming services, because that's the exact same job there. And then Universal Studios, SeaWorld, Knott's Berry Farm, and Six Flags are going to be competing with, say, either Disneyland in Anaheim or Disney World in Orlando. Another one that's going to be directly competing with Disney Shanghai actually is going to be Wonderla in Bangalore. So they are going to be basically the two biggest names in the entertainment spaces like that. So those two are going to be direct competitors. And then as you can see in the top right on the little mouse pie chart, that is kind of the breakdown of all of how Disney makes their money and how everything is split up with them. So a lot of what they're going to be doing is through media. So that's going to be Disney Plus, cable deals, and all things like that. Then your next biggest one is going to be parks. And then you're going to have studio entertainment, consumer products, and more of the interactive stuff like at Disneyland or anything like that.
With as large of a company as Disney, with key competitors and 4 major segments, they need to keep control, and Disney needs management in order to keep control of each of their segments and their staff. Disney's leadership team oversees the world's premier entertainment company as well. Examples of management include Bob Chapek, who is the current CEO for the Walt Disney Company, Josh D'Amaro, the chairman of the Disney Parks, Experiences, and Products segment, Alan Bergman, the Disney Studios content chairman, and Ken Potrock, the president for the Walt Disney Company. The senior executives bring experience and visionary thinking with a shared commitment to excellence, creativity, and innovation to the day-to-day operation for the company.
All right, so if you were looking at how the management was doing overall, as of right now, unfortunately, the CEO, Bob Chapek, is not incredibly highly regarded for some of his recent decisions. He is making good decisions for the company, but it has resulted in a lot of people losing their jobs and prices rising. Now, this is all because of the COVID crisis and everything having to be shut down for so long. All of the parks had to be shut down. They were unable to produce movies or TV shows or anything like that. So they were just losing a lot of money, with also having to pay people for, unfortunately, if they weren't able to come into work, they would still have to pay them. So a petition done by Disney fans has over 75,000 signatures, showed a dislike of how he was running the company as opposed to his predecessor. So they said that they would prefer to have his predecessor back as CEO, but unfortunately, that's not going to happen. So even though COVID's a big factor for the recent budget cuts, they also had started before COVID affected Disney. So the budget cuts started, and then COVID hit, and they had to increase the budget cuts even more after that. So then Chapek unfortunately made the very controversial decision to institute full executive salaries, but he still also laid off 28,000 employees due to COVID and everything like that. But unfortunately, it just makes it kind of weird because the full executive salaries still stayed.
In the income statement, we can see from 2018 to 2020's net income, comprehensive income, and other sources of income. Looking at years like 2018, we can see that they made more money. Reasons for this could be due to the leadership success by Bob Iger, the theme parks being successful, or the company pushing out more products that consumers loved. Then we look at 2019, where it was starting to pick up on the COVID-19 pandemic. The change in percentage showed that, for example, there was an 88.66% change in the net income. As we can also see, a lot of the income went down. Reasons for it could be that the pandemic was starting to begin, or that the company wasn't doing as successful that year as they had bigger plans for 2020. Lastly, we look to 2020, where the company had lost a lot of revenue due to the COVID-19 pandemic. The changes in percentages went down negatively, and as we can see, the company took a toll overall. The balance sheet shows us a date in October of 2020 and September of 2019. We could see things like the assets, liabilities, and equity for the Walt Disney Company. We could definitely see there was a major percent change. Even in the graph, we can see that in 2019, it spiked pretty significantly. Well, in 2020, it spiked in the worst way possible. As said, the reason for Disney's income losses is due to the pandemic, to which the theme park shut down, they had to remove employees, and stores had to be shut down. However, they recouped their losses with main products like Disney Plus and Shop Disney.
All right, so this is their statement of operations between 2018 and 2020. So as you can see, if you go down the list, the year 2020 was quite a different year for them. They had a lot of negatives and a lot of things going down or expenses going up. So basically, if you look through net income from continuing operations, that took one of the biggest hits going from 2019 to 2020. Another big loss was net income as a whole going from 2019 to 2020. And then probably the next biggest one was the net income from continuing operations. And this is due to COVID-19, unfortunately, with them having to keep going with certain operations, like paying some of their employees and things like that. All right, so now we're going to look at the ratio analysis for Disney. So one of their big things on their ratio analysis is their inventory turnover is not good. So that definitely needs to be higher coming through, but that is also due to COVID. Another thing, return in equity, earnings per share, debt ratio, and their DuPont ratio. So all of those things are going to be in the negative or not very good right now, just due to COVID. Everything about COVID really affected all of their daily workings and everything like that. So they were unable to produce as much as they could because of all of the theme parks being closed, the stores, buildings, cruise ships, all of those kinds of things, and then also still having to pay their workers even through all of the COVID reservations. All right, so we are also going to look at the statement of cash flows. So as you can see through the statement of cash flows, their net income from continuing operations has obviously gone down a lot just because they are continuing their operations and continuing a lot of things, but they are getting almost no return during the COVID crisis. And so that is just now starting to come back. And since we don't have their 2021 fiscal year yet, we can't see any of those returns coming back in yet. And then their net gain on investments during 2020 rather than 2019 was also not good due to COVID because they had no way to capitalize on those investments, considering, or at least most of them, aside from Disney Plus, they were unable to capitalize on a lot of those investments. And then also their acquisitions in 2019 compared to 2020. In 2019, they had a lot of money in acquisitions and that did a lot of good for them. But in 2020, unfortunately, they did not have any acquisitions. And so, you know, without any of those acquisitions, you're not going to be raking in any more money because it's going to be kind of everything's going to be on a standstill and you're not going to have any new content.
We now look at the stock journal for the company from June 1st of 2021 to September 1st of 2021. Keep in mind that the stock journal doesn't cover stocks during the weekends nor holidays. When we look at the stock journal for June, we can see that there was significant percent changes for the company during this time. Some were higher than others, like on June 1st, and some were lower, like on June 18th. Some reasons for such significant percent changes and closes is one being the theme parks reopened during this time. And during this time, it is a peak for Disney as the summer crowds come in from all over the world. Then we look to July, which is another peak season for Disney, as we can see significant price increases and downfalls. Just look at the dates like July 8th. There was a negative 2% decrease from July 7th close. Some reasons for these percent changes and closes could be the summer peak crowds that are coming to the theme parks and are buying up Disney merchandise during this time as well. But it also could be for things like Disney Plus, where people want to remain at home due to the pandemic still going on. Lastly, we look in August to September 1st, where there are significant price percentage changes for the worst and yet for the better. The crowds for the summer season are dying down for the theme parks, and people are returning to work and school, which could be examples of why Disney is losing revenue. But at the same time, they are still gaining major percent changes, especially towards the end of August. It goes to show that Disney continues to make revenue for the company, even in the worst of times.
So next up for Disney is the auditing CPA firm. So Disney's management is Corley, who is responsible for all of the auditing to make sure that all reports are correct and in accordance with US GAAP. So Disney audits along the guidelines of PCAOB, the Public Company Accounting Oversight Board. So they follow these guidelines to be sure that all of their financial statements are true, never misstated, and that there's no fraudulent activity or any errors that happen. Disney also utilizes the Goodwill audit to focus on the interim impairment assessment on international channels. So since Disney has all of those international channels and they're in so many other countries, they have to use this as well. So Disney again uses the amortization of produced content costs to do all of their monetization as well.
We now are looking at the current events that are happening for the company currently. One prime example is the article by Spectrum News 1. Currently, the Walt Disney Company recently reported its fourth quarter revenue, which was $18.5 billion. This had fallen short of their predictions, which weren't made clear in the article. But the good news is that it is up 26% from last year's fourth quarter of $14.7 billion due to the pandemic still going on. But what made it most significant was the 99% increase from last year's period in the parks, experiences, and products division. But also, what also made this significant was the company's reporting of a total of 118.1 million from Disney Plus subscribers. It was up 2 million since the end of the third quarter, but it was still significant for the company. Lastly, the direct-to-consumer business segment had a 38% increase of revenue, but had an operating loss of 0.4 billion to 0.6 billion. This could be because of the higher programming, production, marketing, and technology costs. But overall, Disney had made a lot of revenue back from the pandemic.
So some more current events in the Disney company is leadership changing at Walt Disney Imagineering in front of the Florida move. So Bob Weiss, if you see on the very far left picture, worked on Epcot at Disney's MGM Studios and led the creative and design team for the Shanghai Disney Resort. And Barbara Vauza on the right side of that picture also came into Walt Disney in June of 2020 and served as the co-managing director of architectural firm.
Lastly, we look to one last article by CNBC that covers the growth for streaming services. During the pandemic, Disney Plus had gained a lot of attention and subscribers, which gained them revenue and kept the company afloat. It gave Disney time to also push out more content and to test the waters, like a $30 upcharge for a movie. The company gained 118.1 million subscribers, earning a $4. I'm going to restart that. Sorry. Lastly, we look to one last article by CNBC that covers the growth for streaming services. During the pandemic, Disney Plus had gained a lot of attention and subscribers, which gained them revenue and kept the company afloat. It gave Disney time also to push out more content and to test the waters, like a $30 upcharge for a movie. The company gained 118.1 million subscribers, earning a $4.12 global APRU. This was up 2.1 million from the last quarter. This information showed as well how Disney was among one of the top media companies who came out well from the pandemic.
All right, so in conclusion, should we invest in this company? Due to the trajectory of the company and the way that CEO Bob Chapek is running Disney right now, it might not be the best time to invest in Disney. I know they are recovering from everything that happened over COVID, but there's still a lot up in the air as to how Bob Chapek is going to be running the company. So coming off the hit that they took during COVID, they're with them not being able to have the parks open and having theaters shut down, they're still having to make tough decisions about how they can recover some of those losses, even though they are making them up in other ways. So between budget cuts and ever increasing prices of their products, they're not being able to run it as they have in the past, as in the company, and it is affecting how the public is viewing Disney as a whole. So this doesn't mean that Disney won't be back to their tip-top shape soon, as they're steadily recovering from COVID. And once they recover from COVID, then it will be a great time to invest, and it'll be a very trustworthy investment for everybody. And these are our citations. That brings us to the end of our presentation. So thank you very much for listening, and everybody have a great day.